All right, this meeting is being live streamed. This is the Investing Power Hour number 54. Although I don't think any listeners care except us. We're on the road to 100, but everyone I think just listens every Sunday or live on YouTube. My name is Brett Schafer, and I am joined as always by my co-host Ryan Henderson. Ryan, how are we doing today? We're going live at 12:30 p.m. Eastern time. We do these every Thursday. We might be changing it up to a little later because of our schedules. But either way, these go live on YouTube every Thursday. You can watch the replays on Thursdays and then listen on your podcast player of choice every Sunday morning. But Ryan, how are you feeling today?
I don't think most people are going to care what time we do it live because we get like a solid, 6 live viewers or, it ranges. But to the people that do, first of all, really appreciate you and really appreciate all the questions. But yeah, we might be flexible on the time here in the near future. So maybe just keep an eye out for any time changes.
And anyway, we don't really care how people listen on the podcast, watch the replay on YouTube, but it can be very fun to interact, heckle us, ask us questions, and we'll probably answer because there's only a few people on here when we do this live. But Ryan, today, I guess we should say what this Investing Power Hour is. We do random investing topics that we think are timely, will be fun to talk about, we think other investors would be interested in discussing, and we go with a loose format for about an hour, and that's really it. Looks like today you have Andy Jassy's shareholder letter. That is the CEO of Amazon. So we'll be covering that. You have the Mario movie, some housing data, and I got a bunch of stuff like Buffett going to Japan, ride-hailing app annual losses. I think that'll be a fun discussion. Substack versus Twitter, NFT New York City. If we maybe want to talk about that, I don't know if that's actually going to be that fun. We might only have a minute there. But before we get started, let's talk about our sponsor, and that is Stratosphere.io. I just got a message today from one of our listeners, and someone, without sharing who they actually are, is a guest on or has been an interviewee on the show. And he said that he loves that Stratosphere offers a fantastic freemium offering where you get tons of data on. When Ryan's pulling it up here right now, he's looking at Amazon. You have all these KPIs. Now, this is part of the paid plan, but you get KPIs on their total square footage over time. But part of the free offering is you get not all of the historical financials, but at least in a lot of cases, 10 years of historical financials for free, plus tons of other stuff. They have SEC file aggregation. They have just all this different stuff, screeners, modeling, analyst coverage, ownership. Basically, what we like to use it for and why we use it every day is because it saves us time and frustration. That's the key thing when doing investing research, when trying to, aggregate all the information together, is you don't want to be wasting time. And that can happen a lot when going through SEC filings. So we absolutely love Stratosphere. We think you should check it out. Try it out for free, like a lot of our listeners have been doing. And if you want to upgrade to one of their paid plans and get all these custom KPIs like the ones Ryan is showing right now with Amazon, use code CCM, get 15% off. They have various plans, some for individuals, some for professionals. All right, Ryan, why don't you kick things off? What topic do you want to start out with?
We can start with the Andy Jassy letter. Did you read it?
I did. I didn't know it came out. As we were discussing with someone, the newsletter, whatever things that you can sign up for with companies are extremely unreliable. So it somehow didn't show up in my inbox, but I did see, a lot of people were talking about it. So I was like, okay, cool. I'll read it this morning. I did give it a read. Didn't take any notes, but I'm curious what your thoughts were.
Yeah, I'm not sure why the email alerts for companies' investor relations pages are so bad, but
let's get them all at Substack, horrendous. Huh?
Yeah, it's rough. So yeah, Andy Jassy, CEO of Amazon, had his second shareholder letter. Last year was his first. Obviously, Jeff Bezos used to have sort of an iconic shareholder letter, very well known.
Very good writer.
Hard act to follow, yeah. But it wasn't. I guess nothing like crazy stood out. He basically just went through all their business segments, saw what or described what he was seeing, what sort of developments he thinks are promising, and kind of the opportunity within each of them. He also talked about, getting rid of 27,000 corporate roles, cutting a lot of the businesses or the experiments that they were trying. And he never said day one in this one. And he also did not say AI until the last page, which I did like that.
Oh, why? What's wrong with some AI, Ryan? Come on. That's gonna print money for AWS, but maybe we can get to that later.
Yeah, and I'll just touch on that right now. Is basically at the end he goes into their AI initiatives and how, and every company loves now to be like all the companies that have been around for a long time who've probably been doing like fringe AI. It's more like, like they've just been automating tasks. They're like we've been doing AI for 25 years, unlike some of
Yeah.
these new companies. Like, all right, who cares? But he did talk about how big this could be for AWS and talked about a lot of the different capabilities that they've driven for developers. And he says, one quote stood out. He said, "We're delivering applications like AWS's Code Whisperer, which revolutionizes developer productivity by generating code suggestions in real time." That feels like it could be a helpful product. And it's one too where the monetization strategy is very clear. Like the there's a lot of AI applications out right now that are like, what's going to be the source of generating revenue? Like, how are they going to drive revenue? Maybe it'll be a subscription product, but no one knows how well it'll do. This is a clear value add to a business that's already very profitable and huge. So it seems very just like, I don't know, perfect fit for them. The other thing,
do you like how they're for AWS on the AI stuff? Do you like how they are not trying to go for consumer focused and really going for that infrastructure layer and doing what their bread and butter is? I feel like, as someone who obviously is not an expert in this industry at all, I kind of like that they're not going for a big Alexa type project, and they're like, okay, we're just going to stick with the cloud stuff and be the backbone for a lot of other companies.
they did. I think they did mention something about a consumer focused generative AI, but
It's not out
meant
yet
to
or
like
something.
augment the shopping experience somehow, which I don't know.
Oh, that's fine. I mean, well, if they had a conversational thing within the Amazon shopping experience, that's not terrible. Maybe some people like that, but yeah.
Seems completely irrelevant and unnecessary, but whatever. I guess they have worse investments going on as well. I guess some of the highlights, or maybe some of the most important takeaways, they do expect a slowdown at AWS. Not really surprising. People are like slowing, companies are
Sell it all. Stocks to
slowing their
zero.
spend.
Stocks to zero. They're not going to grow at 20% for a few quarters. Stocks clearly zero. Sorry. Keep going.
Yeah, the other thing they went into was basically a lot of the productivity and cost savings they're getting out of their own in-house chips. I thought that was kind of interesting. 40% more, what was it? Cost savings on their, I forget what generation it was, but
Yeah,
their
and I can't
Graviton 2 or something chip.
Yeah, and look, I can't remember exactly. I don't have it in front of me, but I believe they have 3 different chips now for various use cases too. So that's quite interesting. I'm really fascinated to see how the chip war for this kind of vertical integration versus the NVIDIAs and AMD shakes out, because it seems like NVIDIA's always has the lead, but I wonder if Amazon will catch up with certain use cases, or whether this pie is so big that, yeah, Amazon can have some efficiencies there, but they'll still use a ton of stuff from NVIDIA as well.
Yeah, and I mean, hopefully it just improves the unit economics at AWS.
Right.
I mean, I'm sure that's one of the biggest costs of delivering that product for them. The other one would probably be like energy costs for their cloud, or for their server bases, which has probably come down a little bit. So
Yeah,
I would imagine
I think they're
margins might
doing, or go ahead, sorry.
margins might come back up this next year, even though revenue growth could slow.
Yeah, and I think they're investing a ton in their own energy generation, which is just kind of crazy that they're doing a lot of like their own solar, wind projects, stuff like that. And yeah, what I also thought was the most interesting, at least from an investor perspective, we already knew about AWS. We already knew they talked about advertising and basically explained why they do it and what the value they provide is. And I kind of thought that was a little bit of BS where they're a bit just juicing the search results there. However, I thought the most interesting part was the discussion around how there was multiple paragraphs on how they're trying to be way more efficient after the COVID boost in spending on their infrastructure, where he basically said, look, we had to double the footprint in 2 years. It was way faster than we thought, and it was at a much larger scale. So there was just a ton of inefficiency, but we didn't want to lose our customer value proposition during that time. And now that they're moving through that, they've realized tons of new efficiencies that they found across the warehouse network, like, dividing the United States into smaller regions as they've scaled up for so they don't have to, crisscross go across the country as fast. And I just think when they mention, like, in the letter, we're again in 2023 going to increase our assortment and decrease delivery times yet again with their internal network. I kind of think if you're FedEx or UPS, and sure, I guess there's the Shopify powered shops of the world, but you kind of look at that and just go, God, why'd they have to choose us as competitors? Because they just keep wanting to invest in this business or invest in their infrastructure. And they seem to have the mindset, at least on this part of the business, which is the physical infrastructure for the e-commerce network and retail stuff, where they're never going to stop trying to get better.
Yeah, and they even called out UPS. They said we built a UPS or we built a fulfillment, not necessarily the footprint, but the delivery network, the size of UPS now, which it's really staggering to think about. But the other thing that I was thinking about, and we just went through Stratosphere really quickly, and I didn't even notice it until we just did it in the intro, but their total square footage, which I guess that's probably what you'd consider their footprint.
Yeah.
Yeah, it doubled over the last 2 years, but it doubled the 2 years or 3 years prior. So I don't know, maybe saying that, because Jassy always talks about we doubled the footprint that we built 25 years prior in just 2 years. Like, okay, 2016 to 2019, they did the same thing. It went from 179 million square feet to 334.
Yeah, but nominally, I think it's a much larger, and that doesn't include the last mile delivery, which is less of just warehouse square footage. So they basically, and I may be misremembering this, but I think I have the general gist of it, where they had the last mile stuff with those blue vans that everyone sees. That was a project that was supposed to take 6 to 8 years starting in 2019, but they accelerated it to 2 years because of COVID. So there was probably a ton of inefficiency there and a lot of upfront costs. They probably had to overpay people to hire so quickly, and they probably had a ton of inefficiencies there that hopefully, fingers crossed, we'll see how it ends up in margins over the next few years. It leads to just a much better moat. Plus, they actually can start generating consistent operating profits from this division, regardless of, even at that point, I don't think energy costs can be that. Maybe I don't know. Never say never, but there are these. What am I trying to say? Like, I don't think it's just going to be as cyclical with these profitability with e-commerce. But people have been saying that for the last 20 years, so we'll see.
Yeah, and I still think the buy with Prime, having that integratable to other CMS or e-commerce sites is like just a master stroke and wonderful way to leverage your footprint. But we do have a question here in the Slido, or not the Slido, sorry, the YouTube comments here. Scotland says, what's going on with Bud? Dropped steep on high relative volume.
Not a marijuana company. That is Anheuser-Busch for any listeners.
Is that? Yeah. I don't know. I think this was all, I don't follow.
There was some sort of there was some sort of that political thing, right, with Bud Light. I did not follow it closely. There was some conservative celebrities doing stuff. I can't remember.
Yeah, from what I understand, there was a controversial advertisement, and it didn't sit well with what seems like it would be their primary customer demographic. So that's kind of what doesn't make sense for me here is, and maybe I'm wrong, but when I think about if you're dividing it politically, they're the alcohol drinking customer bases. I would think Bud Light tends to trend more towards conservative.
Eh,
Maybe that's just like a
no,
misconception.
no. I think that's misconception. Conservatives are generally richer.
Okay, and I mean, I guess, yeah, maybe Bud Light's supposed to be not on
I think it's
the
the
low
one. I
end of
think,
drinks.
but here's what I talk about because I don't really want to talk about the political stuff. It's just super boring. The investing implications when something like this happens, where there's this news story that's just all over the news and people are like, I'm boycotting this. And this happens with products from time to time.
Happened with
My
Spotify when Joe Rogan was like,
right,
no one ever talks about that anymore. No one cares. It had no
right.
impact on the business. Churn may have like maybe there was 10
I,
people that churned.
well, yeah, and things like that happen from time to time. I guess Spotify is a good example. Here's um typically, and maybe not all the time because it can be dangerous. Typically, I think, and I don't really like the beer industry. I wish they had a little bit more. There's just kind of the craft brewers that are taking share, and some people seem to not care about profitability and stuff like that. But regardless, in general, if you like an industry or if you like a company, and there are these sort of boycott things that happen, typically, I would say, reading historically and examples in business history, almost 100% of the time you can fade these outrage things that happen. And it's not even just modern stuff with social media. It has happened for years and years and years, right? For all of time. And I think generally fading it is the right, it can be smart as long as you like the business beforehand.
Yeah, I mean, I think there's plenty of reasons not to like Bud Light as a beverage, but this isn't the leading one for me. The and yeah,
What about, or go ahead, go ahead.
you know, these stuff are like these things usually get overblown, and
100%.
as you mentioned, boycotts on consumer products that have withstood the test of time usually don't last or have that drastic of an impact on sales. I did see some weekly figures that showed that Bud Light sales had dropped or whatever, but
Hey, who
Anheuser-Busch
knows? Who
has
knows?
a vast
Yeah.
portfolio.
Yeah. And who knows? This could be the one um, exception to the rule of fading it. However, typically, and I think we've already seen it, this news cycle is already over, right? At least I guess I don't follow closely, but
Yeah,
yeah.
maybe. Yeah, I'm not sure. Anyway, yeah, I do think it's kind of interesting though, and
I'm gonna be reading their
if
conference call. I'll read it this quarter for sure. I don't know, maybe the next quarters, but yeah.
it's interesting how beer companies kind of went, they just haven't been very successful over the last 5 years.
Or I'm no expert on their stock performances. Maybe even a little bit longer, like 10 or 15. And I think the issue is one, a little bit of mismanagement, where they got a bit of ham sandwich action there. And
Since
two, it's
2009, it's up 67%. So that's
um
14 years, 67%. Really
so
not
yeah,
great.
not good. Comment here from Scotland says, what do I mean by fading it? Good question. Thank you. I just not worrying about it, where a lot of times, we saw it with Spotify last probably like a year ago, right? Where people said, oh, Spotify's finished. Everyone's going, where? They're going to lose all the artists. And typically, it's if the business does not change just because they're talking about it on the nightly news on Twitter.
I mean, there's been countless incidents where this happened. Remember when Goya beans was like a big thing because,
I think I was like, that was when I was off the grid.
oh,
I don't
well,
remember
I
that
mean,
one.
these things, they last like weeks and I don't think they lead to any structural change for most of these businesses.
Yeah. And
Spotify's a good example, but
yeah. But yeah, with
are
the
there any
beer
other
companies,
examples you can think of?
oh, there are tons, but they're not coming to mind. It's usually nowadays with just political stuff, right? When someone says this is political, oh, we saw an article today. There's an activist talking
On
to
Autodesk?
a software company called Autodesk, which, spoiler alert, we do own. There are things to complain about with Autodesk, but they were saying that their software is used for fossil fuel markets, and you had a great tweet of someone or a screenshot of someone responding to the Bloomberg reporter who, to be fair, is not the activist. They're just reporting on the story, which is going to get a lot of clicks and is an interesting story to cover, but they reported what they say. I think Al Qaeda is using Microsoft Word. Let's cancel them or something. And
Yeah,
it's
just
that's like these stories show up, and it's usually fine. I don't know.
Yeah, I mean, I have tons of gripes about, like, okay, for one, Autodesk, yeah, it can be used by a number of different customers. Not only is it probably being used by the largest fossil fuel generators or producers in the world, but it's also probably being used by the largest solar energy businesses or wind farms or any number of renewables. So it's like it's going to be used by whatever customers they want, or
Yeah, and
whatever
I hate
customers
that.
want to use it.
Yeah, and I hate that. I guarantee that guy that was the activist with the photo had about 20 products on his clothes, shoes, whatever that were oil based. So I just once you learn about the oil industry, you're like, well, I don't. Maybe we shouldn't just take him to the what do they call that thing?
Woodsheds
Take him to the
or what?
woodshed, or the thing that chops off the heads during the French Revolution. What was that called?
Oh,
Metaphorically, the guillotine. We shouldn't take him to the guillotine. Yeah. But other topics, right? I want to get through these. Yours is the Mario movie, which
oh
again
wait,
we
we do have one more
already have
comment. Tony Shields says Equifax after the hack. I'm not familiar with that one, but yeah, I mean,
Oh,
there's
boom. Yeah, a lot of security hacks that can be a thing too.
100%. Well, yeah, let's talk about the Mario movie. I mean, the shareholder letter, it's good. Go ahead, read it. If you're interested, I think Andy Jassy's a good thinker and writes a good letter, so it's worth the read. But
It'll bias you though. It'll get you bullish. So just fair warning, all the shareholder letters that people write, you got to go in because we fall prey to this too. You got to go in and be like, damn, I should own this thing because they're going to talk their book a bit.
I mean, I kind of look at the letter and think like they are spending a lot of money. So, it's like there's maybe some pessimism that could be taken away from it too if you're fixated on them expanding margins in the short term. But yeah, let's talk about the Mario movie. We're Nintendo shareholders. I went and saw the Mario movie. I thought it was great. Did you end up seeing it?
I did. Yeah. And got the recliner seats. So, got those premium tickets to get a little better take rate. I love it.
Yeah.
I think side note, you have to use the recliner seats unless they're just way more expensive. If you pay a little bit more for those recliner seats, the experience is just so much better.
Yeah, it's significantly. Yeah, so finished the weekend with $377.5 million in first weekend box office sales. That is the biggest opening weekend ever for an animated movie. Now, granted, they had a 5-day total versus, I think, Frozen 2 is like the second largest. Frozen 3.
Oh no, 3 days. Sorry, yeah.
Oh, Frozen 2's was a 3-day comparison, so not not exactly apples to apples, but still, I mean, looks like this is going to be on pace for significant box office sales overall. People are saying that $1 billion is basically locked in. Following the movie, game sales for Nintendo look like they jumped pretty quickly if you use the UK as an overall indicator. So you found this, and I'm glad you did. So Mario Kart 8 sales, which is their premier Mario Kart game, we're up 13% week over week. Super Mario Bros. U up 22%. Super Mario 3D World up 39%. All these week over week. This is exactly, I imagine, what Nintendo would have wanted. This was the goal. Obviously, I probably exceeded their best expectations. Not only could this, and at first I wrote the movie off as like whatever, it's like marketing, basically, like profitable marketing, because you have a wonderful flywheel effect. You basically become very Disney-like, where the expenses for the movie end up being well worth it, and then on top of it, you can cross-sell all your other products. But I mean, I guess the movie will probably contribute a fair amount of money or profits to the business this year as well, alone, on top of all the game sales they're going to generate from this thing. Do you think?
I was kind of running some numbers, and it's tough with these box office estimates. And for box office only, given their trajectory, if they hit $1.5 billion, I think they could clear at least 300 million in earnings, which would be fairly significant. And that's just from the box office. And there'll be plenty more from streaming deals, digital downloads on wherever, the Amazon TV, Apple TV, wherever, stuff like that.
And from what I was seeing, box office sales are usually around like 20 to 30% of overall sales that are generated from movies like this. The long tail is really in those streaming deals.
And there's probably about 10 million, maybe. Well, you shouldn't, probably not all of them won't buy it, but there's a good amount of hardcore Mario fans that really, really love Mario. They play all the games. And I wonder how many of them are going to buy it for like $20 when it comes out, just so they can own it forever.
Yeah, I mean, this was a hit across the board. I guess it makes me think, well, for one, I think Nintendo stock reacted positively, although it never seems to trade.
It's that meme where it's like,
in either direction.
Yeah, it's the meme where they say, come on, do something with that stick figure. That's Nintendo stock. They could literally say, wow, we doubled our cash flow this quarter. And people would be like, well, I don't know. Like, that's one quarter. What about next quarter? Everyone seems to fade them every time, like every year. It's quite interesting.
Like, but are the consoles gonna stick? Like, what if this is in the next Wii? It's like, okay, it's been around for like 7 years.
Hey, all serious, that is the serious bear case. So it could happen. But when every quarter it doesn't happen, people just go about. It's so funny where they go, well, what about next quarter? Are sales gonna slow down? And then they don't, and they go, but what about next quarter? It's funny.
Well, yeah, it is probably the fair bear case. I don't know. I think this probably is a big eye opener for a Nintendo management team. Hopefully, it means they're going to lean into this more and really kind of take this multi-form media strategy as a perpetual thing to do. I do think I saw people basically saying, like, oh, they're not going to have, how are they going to repeat this? First of all, they have lots of really solid brands. I think Zelda would be a very successful movie as well. Might not be as successful as the Mario movie. Who knows? They could easily run a second Mario situation. They could base something off Mario Kart, a racing movie. They could do Super Smash Bros. They could do something that incorporates Wario or Waluigi. I mean, they have Pokemon basically.
And that Pokemon does it themselves, but yeah, they already do that.
So many different directions they could go. I think this is repeatable. I also think it helps with the parks. Even though this is like just confirming our biases to begin with, I think it is becoming more Disney-like.
Yeah. They're not going to, and look, they're not financing the movies all themselves. So they're splitting the profits with Illumination and Universal, and Universal's capitalizing, investing, I believe, all the capital into the theme park. So it's not the same, but they are going to earn a nice royalty stream from that. I have three questions though.
Hold on. Scotland says Rotten Tomatoes for Mario movie was 57% from critics, 97% from the audience.
Yeah,
it
critics
just goes to show
it's
absolutely pointless Rotten Tomatoes are.
That's actually
it's always wrong.
No, that's actually a great indicator. When the critics fade something and the audience loves it, it means it's going to be a really fun, dumb movie. And that's what it was. 90 minutes, kind of nonsensical, but whatever, kind of funny and fun. But yeah, okay, I have three questions for you. I'm going to go through them myself. Actually, I hope I remember all of them. Yeah. Okay. All right. I think I remember two at least. First one. What's your prediction for box office? My prediction is going to be 1.5 billion worldwide for the Mario movie. I think once we incorporate the Japanese market, which hasn't launched yet, I don't know why, but it's going to be coming out in a couple of weeks. Second question. What do you think the ideal cadence for the company in a shareholder perspective for movie releases? I think one a year would be ideal, but I would not expect them to do that. I believe they'll probably hit a once every 2 years or once every 3 years.
Yeah, at least at the early on, I would say that's accurate. And you basically stole the words right out of my mouth. I was going to say 1.5 seems reasonable. And once every year would be great. And it hopefully avoids, and this gets to Scotland's next question, which is on the topic of movies, Marvel has been really underperforming for Disney. What's going on here? I want them to avoid becoming Marvel like where they just basically dilute the brand.
Well, with Nintendo, there's a lot of things to worry about. The one thing you cannot worry about is them diluting the brand with too much quantity. That is never say never. With the current management team in place and the current culture, which will last at least for a couple decades, with Miyamoto at like age 70, he'll probably be around for at least 10 more years unless he has a health scare. No way they go the Marvel route. They just won't let that happen. That's their whole DNA.
Yeah, and I think one movie a year is enough to be hopefully contributive to the bottom line, but also enough to keep fans engaged and keep them either buying new games that you release in sequence or in conjunction with a movie, or as the parks continue to grow, as they start to add more parks throughout the world. One movie a year should hopefully incentivize.
Yeah,
When you've got one movie and 5 good games that come out on the Switch every year, that's enough to get people to go to the parks, I'd say.
Yeah, we don't need to go through the whole litigate the whole bull case. There's also the upgraded hardware stuff that people can go look at and read about themselves. Everyone has their own take on that, but I think fingers crossed. I don't expect them to happen, but I would love for them to line up things really nicely with game releases along with other content and IP they're doing. Because I believe Disney does this, and it's not obviously not like on the same day releasing something, but say, let's just use a character. They do a spinoff with Donkey Kong. That seems like people really love that Donkey Kong world or whatever it was called. In the movie, they do a spinoff Donkey Kong movie, but around the same time they release that, they also release a Donkey Kong game or a Donkey Kong focus game, whatever you want to call it. And you could probably see some really nice flywheels going there where you got some new fans for Donkey Kong. You can buy the game. They already have a Switch. And at the same time, you have a Donkey Kong themed ride at your theme park, which would just be fantastic. But I would set my expectations low that they're going to optimize like that. They don't look. Sometimes they don't care too much about shareholders, and you just gotta live with it. With Nintendo, they focus on, and this might sound cheesy, making magical family content. That's their number one priority. And with Zelda, obviously, and other stuff, it's more for adults, but that's their number one priority. Yeah, it might make a few billion in profits, but that's just the outcome. That's not their main focus.
All right, let's we got a lot of stuff to talk about today. So maybe dive through some of the real estate data.
Sure, yeah, I'm all over that.
This always seems to get controversial feedback, and it's always a nice video we can splice and hopefully get some clickbait in there. But anyway, Zillow updated homes data came out. I can't go through all the data because it's basically just this enormous spreadsheet, but it's got all the major metropolitan markets and the average home price changes basically month over month, year to date, down from peak, and year over year. Year over year, this kind of surprised me. Very few markets are actually down relative to last year. So you can see there, all right, Miami's
I'll zoom in on
up 11%. The only ones that are really down anything sizable are San Francisco and Seattle's getting there.
Dude, for anyone that doesn't know, Seattle home prices were up even more than San Francisco over like a 15-year period. So, we've had some painful years, and it's not. Yeah, we might be the anomaly, and Austin too. Well, yeah, they kind of were in the same bubbly stuff there.
Austin, Seattle, Sacramento, and San Francisco were the big ones that were down. The rest of them grew. The average home price actually grew year over year, and so the reason I say this is surprising to me is because every month we get new data that shows how, I don't know, unaffordable homes are today. Redfin just recently released a report, says mortgage applications are down 35% from a year earlier. Google searches for homes for sale were down 20% from a year earlier. Listings are down significantly as well. And maybe that's the reason. Is they've got a good quote here. It says, Uh, elevated elevated mortgage rates are perhaps an even bigger deterrent for would-be sellers than for would-be buyers. Giving up a 3% mortgage rate for one in the 6% range is a tough pill to swallow. And they go on and basically say it's really hard to buy a home if people aren't willing to sell it. So if maybe how long can that last?
Who knows?
I'd be very
Yeah, well,
surprised if that continued. Like people have to sell, I don't know, people have to move for logistical reasons eventually.
yeah, and I think what you have a note here. I'm gonna just share this quote because this is kind of what on my maybe evolving take on the housing market. Which again, I'm a total spectator here, no industry expert. But from Modest Proposal, the popular Twitter account on FinTwit said, not saying housing prices are not going to come down, but everyone should note that nominal GDP is up about 24% over the same time, which I think he's referencing pre-pandemic. So maybe if housing prices stay flat or even grow a little bit, but inflation is still hot, then you're actually not, it's actually a little, housing prices on a real basis are going down. So that can be painful, I think, for people who aren't seeing their wages rise as fast as, keeping up with inflation. But I wonder we've seen inflation come down a bit, right, in recent months. And my next thought is if housing prices don't come down and they just get inflated away, does that mean inflation is going to be a little bit more durable? It seems like it's all interconnected. If you kind of get what I mean here, where is it possible for inflation to go down if housing prices don't go down, or right? But if they don't go down, then they're just going to get inflated away, and then they're technically going to go down on a real basis. So it feels like the problem is going to solve itself, unless we have a huge credit crisis or something like that. But also might be talking out of my ass there.
Yeah, every time I see new data, it always makes me, well, I keep thinking make it make sense, because you've got a huge disconnect between willing buyers and the current prices, which obviously, I mean, they can't be sustained. There has to be some sort of convergence over time, or else the economy is going to have issues, because if people are spending 50% of their income every month on their mortgage, there's less to spend elsewhere. But then on the other side of things, you think, I mean, that Redfin article brings up a good point, which is if I'm a seller and I've been paying down my mortgage for the last 20 years at 3%, and I've refinanced it on the way down, I don't feel very encouraged to move and acquire a new mortgage at 6%. So it's probably a lot of people just waiting, and that's why listings are down like 20% year over year. No one wants to list their home and sell and then go have to buy a new one. So maybe it's just less movement over time.
Yeah. And I want to talk about this another time, but both our families are in that situation, right? We got parents that are kind of near the end of the mortgage, and they're kind of like, in that phase where they potentially could be looking to, since all their kids, I believe, generally are in like their 20s and kind of out of the house and stuff like that. I don't know, like
Home equity is at an all-time high.
maybe they like to move, but what do? They're a little bit stuck. I'd love to explore another topic on a different episode where we don't have as much news on what happens when all this home equity that the people who bought in the 70s, 80s, and 90s have built up get passed down to the other generations, and how that shakes out throughout the housing market, because it's going to have a lot more wealth for some of these younger people, but I wonder what they're going to do with it. Are they going to sit on it? Are they going to rent it out? What's the plan? But I think we should talk about that another day. Anything else on housing before I want to talk Taiwan Semiconductor, Buffett in Japan/Asia, and Apple?
No, go for it. Do you want to start with the HBO Max name change? Because I find this absolutely hilarious.
What's your take on the HBO Max change to Max?
Well, yeah, just to give some context, the HBO Max is they are merging the Paramount Plus and HBO Max brands, I believe, and converting it into Max. Here's kind of the irony in it. The last Succession episode, there was that time they were trying to release a statement, and everyone on the board and all the kids were like, "Well, I just think my name should be on it. I think it's important that I'm mentioned in there." And that's what it feels like Paramount Plus is here. Like everyone resonates HBO
HBO
with.
Max, not Paramount Plus.
What was
You
it?
said you said Paramount Plus. I think you meant Max.
No, they're merging the brands, right?
Discovery
Or
Plus.
Discovery Plus. Sorry, not
Yeah,
Paramount.
yeah.
Discovery Plus.
It's confusing. There's too many services.
Yeah, everyone resonates or probably thinks HBO quality production. Discovery Plus, most people probably don't know what it is, but I guarantee someone at Discovery is like, well, you can't just forget about us and lump us into HBO. I think it's important that we're a part of it or it's a neutral name. And that's essentially what you've got is you, instead of going with high quality production, everyone knows, I mean, HBO is synonymous with that. They're picking a half and half name, which is the stupidest way to go.
Oh yeah, they're mismanaged. I mean, I look again. I'm sure they got a lot of smart people over there, but they are dropping the ball so hard. It doesn't seem that difficult to manage HBO because it's such a good asset. I feel like all you have to do, because one, their app is terrible. It's so slow. and the UI, I can't find stuff sometimes. I'm like, how do I find Succession on here? I search, it doesn't even show up. I'm like, what is going on? I want to watch your number one show. So just let's get the tech. Just copy Netflix. Come on. But maybe that's impossible. Either way, get as close as possible as you can do it. Two, let's just separate the two apps. You have HBO, great brand, very different. People like, small portion of the population really likes it, and they're willing to pay a good amount of money. They'd probably pay $15 to $20 a month forever, especially if they keep up their, and they'll have great margins because they don't have to produce that many shows. They really just do one big one at a time. And compared to, an Amazon Prime or a Netflix who just has way higher content spend. And then just separate it out to the Discovery Plus one, or whatever you want to call it, for kind of reality TV, nature stuff, but then just offer a bundle, right?
Or I would say just make it cleaner, add Discovery Plus's content to HBO. And if people want,
I don't think that would work.
I think the reason they're doing this, the reason they're pairing this is because this Discovery Plus doesn't make sense on its own. It's not economically
maybe that's fair. That could be the big issue here. I think what would be tough by putting Discovery content, which is just reality TV, I don't want to call it garbage, but reality TV, pretty laid back, casual watching of these shows like, I don't think they have the Kardashians, but stuff like that, right? I do not think that would be very beneficial to HBO's brand if it was within the HBO app. I just don't. If that's some of the stuff you're scrolling along and through there, it just, over time, I would just be worried about that as a long-term risk, because I think
that's basically Netflix's model.
I know Netflix has been so successful regardless of this, but I think they did make a mistake by not separating out somehow their premium stuff, because they do make some stuff that's just as high quality as HBO. Not as they don't have the same hit rate, but I really, and maybe this doesn't matter, but I get a little bit more hesitant starting a Netflix show that's supposed to be like a high quality drama or something like that compared to an HBO show. I trust them much more. And I think that's the only advantage HBO has. I do not want them to squander that. Or I would be so worried about it. That would be my biggest worry, is squandering that as a company.
I mean, but it's worked, right? For Netflix. It doesn't matter if people say, "Oh, the quality's not there. The quality's not there. It's not."
That
HBO.
Works for them.
Okay,
it works for them. It works for them. I don't know if it works for the HBO Max.
But people aren't. I mean, people still subscribe to Netflix because they might get a quality show once every 2 months, or something quality every 2 months, and there's that long tail of stuff that maybe it resonates with one audience. I don't think there's any harm in having like a disc. Maybe treat it like Disney Plus, where you have Disney Plus has like that, basically tabs where you could lock into Discovery.
That's probably,
or whatever their micro brands are. You could just put a Discovery Plus tab within the HBO segment, and then it's not that big of a deal.
Maybe we solved it, where they have Max or whatever it's called, and then within it you just can go to either HBO or Discovery shows, or however they want to divide it up to the different Discovery properties. It seems like maybe it's not going to be as big of a deal, but I just don't think copying Netflix is going to work at all.
I don't think having separate apps is, I think that strategy would just suck. You gotta, if you are not, if you have a subscale streaming platform, it's too costly to run. It's just not going to work. You gotta
Maybe it can be
try to make
one.
one app that's really valuable to customers and has enough users. Because I mean, maybe I'm the only one, but I segment it as how many apps do I pay for? What apps can I
Yeah,
get rid of? So it
I don't know.
consolidate them. I don't know. I mean, they are
I don't
consolidating
think.
them, but don't do it under the Max brand. Um, all right.
I don't. Whatever. We can talk. Maybe it's impossible. Maybe there's just no way for them to get out of this without just having HBO being really subscale, really
And maybe
small.
this is why it's such an advantage to just be the pure play streaming provider where you're starting from scratch and you're not having to please two different teams and having to basically retrofit linear content for the streaming market.
Maybe, maybe.
All right, let's
Yeah.
talk about some of these other ones.
Okay. Buffett likes Japan. Why don't? Okay, let's do
The
the
shame he isn't on
Taiwan.
Nintendo.
Yeah, he likes it's same as Disney, but I don't think if he would have bought it, he would have bought it already. Okay. This is from Walter Bloomberg, trustworthy source. No, Walter's trustworthy. Great service on FinTwit. Here's the headline. Buffett says Apple Incorporated, Berkshire's largest stock investment, is a wonderful company run by a great CEO. Oh, okay. But before that, the other one was they sold Taiwan Semiconductor because of geopolitical risk, right? Now, I try to tweet out kind of because I get confused about that because I think the companies are so intertwined. And maybe he was just trying to save face, or sometimes he just is like he doesn't want to say, "Look, I just sold it." But I get confused on why there's geopolitical risk for Taiwan Semiconductor, but not with Apple, and how that's not a bigger deal for him. And I want to hit that, but first, let me show you a nice chart for the listeners on Stratosphere from Taiwan Semiconductor. This can maybe hit on a general topic as well. Let's load it up. And it is conversion of operating income to free cash flow. Here's a nice, and look, if you look on here, you can do, this is some of the great charting tools we have lined up for any of the listeners. Operating income versus free cash flow for Taiwan Semiconductor manufacturing since the year 2000. So you can chart it both really easily, and you can go back really far. And yeah, you can do a lot, with all the other tools on there. They have KPIs with this company as well, which I thought was cool to look at. But the question I have is, and this is maybe what I'm hinting at, where Buffett might not have liked this business as well as other ones, because he does like when companies turn earnings into cash flow. I think I'm saying it correctly on here. Every year since 2008, yeah, they have generated less in free cash flow than operating income. So they're perpetually reinvesting. And there's just not that much available to send back out to shareholders, even though this revenue base on this company is just ballooning. So I'm curious your thoughts on that. And then maybe we can talk the geopolitical stuff, which, as we know, we're the key geopolitical strategists here, but maybe we can share some personal investing perspective there.
Well, it is still a lot of cash flow. I will say that it's
It's not
still
zero.
20 billion
Yeah.
and still growing. Yeah, I guess in terms of like them versus Apple, obviously there's geopolitical risk with Apple, but I would say less so. I mean, it would obviously slow them and be a
My
huge
argument,
hindrance. But
my
like, I
argument is
mean,
the same. My argument is they have the same. They're
Taiwan
tied at the
Semi
hip.
is Taiwan though.
Yeah, but look, if they go, it's like if what's the thing? If I go, we all go. Isn't that what it's like? I think that's from Elf. Like that's that guy from Elf saying, "If I go, we all go." I think that's Apple goes down with them, and it's not. The brand survives clearly.
But it's not, yeah. It would suck, obviously, for probably the whole world. But
Yeah, which is why I'm guessing it won't happen. So
I agree.
I don't know.
But I think it would be a slow return to normal for Apple, probably a very slow return, but I think the world would adapt somehow outside of Taiwan. Um, it might
The
be,
Taiwan semi wouldn't. They're already building in America and Europe. That's my question. It's like they're gonna get a lot of manufacturing capacity, and this is my argument because a lot of people are on the side of you and Apple and Buffett. It seems like where they think TSMC is higher, and my thinking is they're already investing so much in the United States and Europe, right? Or maybe even Korea and stuff like that. Japan, places that aren't as susceptible to invasion. Yeah, it's a lot less efficient because Taiwan is just the best place to manufacture chips in the world. But that's, I think, given how important this industry is to the global economy, if push comes to shove, the governments are just going to give them money because they're the only ones that can do the cutting edge right now. And yeah, it'll be more expensive in the United States, but
I mean,
they're
that's what
going to make
the
it.
Taiwanese government did.
They're not going to let Nvidia go to zero. They're not going to let Apple go to zero. They're not going to let all big tech just collapse their growth rates.
Yeah, but it's not just a matter of
fix this. And so
I don't think it's purely a matter of investment.
Why so?
Maybe you can invest to build out manufacturing capacity or capability that Taiwan has, but it would take years, right? You think it's purely just like the dollars? They don't have enough dollars to replicate it, or
no? It's going to be
the system, the processes.
Yeah, why can't the people move here if they get invaded? I mean, do you think the Department of Defense doesn't have a contingency plan with a bunch of 747s to get the engineers and the ASML machines on a with some F-18s going across the Pacific Ocean? So they'll get I guess there. If they don't,
I think the engineers are probably a big part of it. After
they're chip war book, and they're gonna leave. And they're if I don't understand. Like, I mean, maybe China could force them. I guess we're going down some weird rabbit holes here, but it's not like, yeah, it'll be less efficient in Arizona, but so what?
So what in terms of
like the business isn't going to die.
That's the pitch for me in Apple, I guess.
Yeah, so their costs are Apple's costs are going to go up because TSMC is not going to. They're going to have margin because.
I mean, even if it's subsidized costs, I think getting all the engineers to America and restarting your footprint is probably pretty costly too.
Yeah, of course, but like
I don't know, it's unsolvable.
Well, who knows? No, yeah, I mean, it's a big who knows. I don't know. I just think Apple.
Maybe it's just
the risk. I think Apple has the same risk because, and think about, they would get banned from China, right? Like China would. That whole. I honestly think Apple. I think the
difference is Apple has $100 billion in cash flow every year that it pays out to its shareholders.
Yeah, well, that cash flow would turn to the current cost basis would turn negative if.
Yeah.
They have a lot of
Taiwan, TSMC throughout that time. Let's say the next 5 years are a very risky period. Nothing changes, but it's the same sort of tension-filled relationships.
Narratives and stocking. Yeah.
At least throughout that time, all the cash Apple generates is going to get paid back to its shareholders.
Yeah.
TSMC is going to probably get plowed back into either.
They have a yield right now is 2.6% dividend.
Yes, it's not that far off from Apple. Apple probably has 4% if you combine
buybacks
and dividends.
Yeah, don't know exactly right now. Maybe 5%. I don't have the calculation in front of me.
I don't know.
I just think they're the same company. Yeah, well, let's hit another topic before we go on. But I look at the earnings multiples, and yeah, maybe Apple's better brand. Buffett loves that.
Cash flow multiples aren't that far off from each other.
Yeah, it's true. That's fair. Yeah.
And there's probably a big chunk of maintenance CapEx that's required there. Not just growth CapEx.
Yeah.
Yeah. All right, let's talk Buffett in Japan.
Wait. Okay. Let's see what did he say? I think he's always so vague. And there's some comments here. Or do you have any comments? I thought I saw some pop up.
Someone asked about Yellen's speech from the other day. I didn't really say anything. And to be honest, I watch very little of those.
Yeah, so I didn't watch it either. I think those speeches like Yellen, Powell, and stuff lead me to be more confused than getting any insights. But here, I got it up here. Here's what Buffett said. And they always have the same picture of him going like, that one where he's going like this. He's talking. They always have that still shot. Here's what he said about Japan. At the moment, we only own the 5 trading companies. There's always a few I'm thinking about. And he's considering increasing his stock investments in Japan. I think there's been a lot of interesting dynamics in that country. One, their demographics aren't the best, but it seems like they're getting a little bit more shareholder friendly.
Yeah, and they're cheap, and he raises the idea that interest rates were so low and some of these companies had earnings yields of 14 or 15%. So you got 0 interest rates and 14 or 15% earnings yields with potentially management teams that are more shareholder friendly and will grow. And I think he said dividends since they started investing in those companies have grown 70% in total. So yeah, I mean, it makes reasonable sense, but I guess having owned a Japanese company for a long time, there are certainly the pitfalls.
There is a lot of earnings, multiple compression, although Nintendo is a different case. Yeah, and here's also what he said about the companies and why he likes them. He says, here's the direct quote. We feel that these 5 companies are a cross-section of not only Japan, but of the world. They are really so much similar to Berkshire. They own a lot of different things. So I think he's just saying, look, this is a perfect way. And it's not, I don't think it's harder than this. Japanese market is cheap. These companies are a cross-section of the Japanese market. I'm going to take a chunk of that and bet that Japan is cheap. They're going to earn. That's that.
Yeah, I think it is probably that simple. And these are, what are the businesses again? They're basically just like conglomerates.
Yeah, I think you'll recognize like Mitsubishi. I believe they run similar-ish to Berkshire, but not obviously the same track record of phenomenal performance, where they own a lot of stakes and stuff, and they're just trading companies and they're diversified conglomerates in a way. Although, any experts on those? I know I'm probably missing something, so don't complain. All right. And before we close out, I want to hit this one. Would you download this app? I wonder if you saw this. Someone was tweeting out things that A16Z has invested in, and they get a little bit, they're not afraid to invest in some strange stuff, some strange digital social stuff. Curious if you saw this. It's in A16's new investment portfolio. It's called New, which is the cringiest name I've ever seen. A project described by the BBC as, quote, the app that lets you pay to control another person's life. Indeed, the app invites you to, quote, sign up to become a creator and have people pay to vote and bid on your life choices. Now, Ryan, how much do you want to control the investment decisions of someone and watch them do I would just absolutely love to find the stodgiest deep value guy that only buys stuff with PEs in the single digits and loves cyclicals and just force them to buy something at 30 times sales. If you did like it, I mean, that's pretty cruel, but I think that I would never actually want to do that to someone, but that just seems so comical to me. But this app, these things that A16Z invest in seem batshit insane.
Yeah, I'm sure it seems a little dystopian. It's basically that movie. It's like the plot of that movie. I can't remember what it's called.
The Black one, is it a Black Mirror episode maybe, or you think it's something else?
No, it's something else. But yeah, maybe that's our new business idea. New for finance.
Yeah, you can force people to buy. You can force us to go long Bitcoin, but you have to pay us for it.
Would you ever in your most down bad days, would you ever sign up for the new and let people just control your life decisions?
No, never. Do we need to do it? Do we need to have a intervention with A16Z as an investing industry? Just say guys, I know you're just raking in fees from these pension funds, but let's get real here. Let's settle. There needs to be an intervention. I think they're hanging out with MBS in Saudi. I mean, come on, guys. Let's get let's rate it in. Let's rein it in.
Also, it seems some of that Web3 talk from a year ago has not aged too well.
Yeah.
Did you see their slides where they just basically highlighted every non-Web3 company as like a success and then talked about how it's good for Web3? It's like just the most confusing. I don't know.
Oh, I can't. Yeah, I did not see that. Although what's crushing to me is, and I should check this. I believe they are a huge investor in Substack. So all these are going to fail, and then Substack's just going to mint them $1 billion. They're going to make out like bandits again. All right. I think that's going to do it for this episode. This is a really fun one. Thank you for the people in the comments. Come back Thursdays. I think we're going to go a little later because of our schedules, but TBD. We'll figure it out. And it doesn't matter really, because if you don't join us live, you can watch the replays on YouTube. You can listen to the shows on Spotify, Apple, or wherever you get your podcast every Sunday. Give us a review on either Apple or Spotify. A positive one would be greatly appreciated. And let's see, disclosure. We are not financial advisors. Anything we say on the show is not formal advice or recommendation. We are general partners in Arch Capital, and clients may hold securities discussed in this podcast. Make sure to check out Stratosphere. Use our code CCM. Great partners. We know a lot of listeners have been trying them out. Thank you for tuning in, everyone. We'll see you next week.